Exactly.
A realtor organization would never suggest that someone sell their home on their own.
Right. Yeah. Yeah.
Why in the world would you prepare your own taxes?
Yeah. I mean, for some people, you get a W-2 in the mail and you can stick it in TurboTax and it'll come out just fine, right? Most often it's much more than that. You know, even one spouse is self-employed, somebody sold a house, somebody's got investments, whatever. We're not all experts in everything.
Yeah. Welcome to Lawrence Real and Local, Keeping It Real podcast, presented to you by the Lawrence Board of Realtors. We are your go-to source for all things real estate in Lawrence, Kansas. I'm Lexi Haskin with Flint Hills Mortgage.
And I'm Emily Robertson with McGrew Real Estate. Together, we're here to make the journey to homeownership a breeze. Join us as we share insider insights, expert advice, and a dose of fun along the way.
Okay, so welcome to the Lawrence Real and Local, Keeping It Real podcast by the Lawrence Board of Realtors. My name is Lexi Haskin with Flint Hills Mortgage.
And I'm Rob Hulse, the assisting co-pilot today with the Lawrence Board of Realtors, standing in for Campbell.
And we are joined today with Amy Sand with Stonecreek Accounting, and we're just thrilled to have her here.
Oh, thanks, guys. I'm happy to be here. Talking about tax. It's really exciting.
I know. I mean, it is one of the most exciting topics that I think we've had to date.
Oh, great.
Okay.
Sorry. I wasn't trying to say that it wasn't.
Anytime you can keep more of your earnings, that is exciting, right?
That's true.
Yeah, that is true. So today
we can have fun and be sarcastic, but this is fun. This is good.
This is good. Yeah. I was just giving Amy a hard time. I know her.
I know.
But we're just going to do a homeowner's guide to tax prep, buying, selling, capital gains, all the things.
Great.
So let's just dive in.
Let's go.
So just for post-home purchase, so what are the key documents that a homeowner should provide to their accountant after buying a home?
So that closing document that you get that has the summary of everything on it, that's the most important thing. That's what your accountant's going to want. They want that closing statement for buying or selling a home. So, but you should keep that anyway. You should have that in your records. You should have a digital record of it, a paper record of it. But that is the document, the one that shows what you paid, what taxes, where your mortgage is, all that stuff. That's what we want to see. That's what we're going to ask you for. So, after you walk out of the title company, maybe you should just make a stop at your accountant's office and drop that off. That'd be ideal, right?
Yeah.
Yeah.
That's actually a great idea.
Yeah.
It is.
Yeah.
And I know some realtors and sometimes lenders towards the end of the year will send out the settlement statement to their clients just so they have it for taxes coming around, because a lot of people don't keep it. I remember when I was in title.
Or they can't find it.
Or they
we
can't
tell
find
clients
it.
all the time, your realtor or the title company, they have a copy of that. You can give them a call. They're going to email it right over to you. You've seen that. You've signed it. So we know you have it somewhere.
Yep.
So that's what we want to see.
When I worked in title, I remember the end of the year around tax season, so many, will you please send me your settlement statement? Will you please?
Yeah.
It was a thing.
Yep.
But so, are there specific tax deductions homeowners can claim after purchasing their home?
So mortgage interest is deductible as an itemized deduction now. So we always recommend, this is a great time to be on this podcast because it's the end of the year right now. So in January, you're going to get that 1098 from your mortgage company. So your accountant is going to want to see that document. We're going to, or you're going to put it into your tax software if you do your own taxes. It's going to show the, property taxes you paid probably on that 1098, or you're going to want to get that from the county, which you can log into the county website and get that information. But those are, itemized deductions. You should, provide those to your accountant or have those available when you do your taxes. So yeah, it's the time of the year where those forms are going to start coming in the mail. So put those somewhere safe. Open them up. Open your mail.
Open your mail.
Open your mail. And so that you can take advantage of those. Because some people will say, oh, well, I don't itemize, so I don't worry about my mortgage interest. Well, just because you don't itemize federally doesn't mean in Kansas it might not, it might get you a little bit in Kansas. So, you should have that. Yeah. Wait for that. And if you refinance, you might get a couple of 1098s. So you might want to keep an eye out for more than one document, something to keep in mind.
So is property tax deductible?
It is, there's, so personally you have that as an itemized deduction. If you own a business, let's put it that way, like especially if you're self-employed, you really want that because that's going to figure into your business use of your home. So for anybody who's self-employed, you really need that property tax, mortgage, interest, all of that to take advantage of all of those deductions. Same with utilities and stuff. So yes, you should provide it to your accountant because everyone's going to be different. So I don't want to say yes, it is or no, it's not. It depends on your situation, but always give more information. The more information you can give to your accountant, the better.
The more that it can be utilized to help you out.
Mm-hmm. Yeah.
Yeah.
Yeah. And sometimes, in Kansas, it would make a difference, but not federally. So you always, like you said, anytime you save money, it's exciting, right?
Absolutely exciting. Keep the money in your pocket.
That's right.
No doubt. So okay. Sorry, left turn.
No.
Home office deductions. So like your bills, your interest deduction, property tax, a percentage of those things.
If you are self-employed, So
you have to meet it some standard there.
Yeah. So if you have an office in your home, if you're self-employed, you take a percentage of that. If you're a W-2 employee and you just happen to work from home, there's no deduction.
You're going to SOL.
Yeah, you're. But
I'm not going to say what the acronym means. So Google it.
Yeah.
I'm not saying it on
Everybody
the podcast.
knows what you mean, Lexi.
Yeah, you never know. It could be that one person.
Yeah,
but it truly has to be dedicated space, right?
It should be dedicated space. Yes.
Yeah. Yeah. Not the great room, which sometimes is TV with family, and sometimes
we all know how that goes when you're self-employed, right?
Yeah. So when you're doing sorry, another left turn, because now I'm thinking if it's a dedicated space, do you only take out certain amount of square footage from that for taxes? Is my question even making sense?
Yeah. So, I mean, we have a nifty little tax organizer that we send to our clients, and it tells you, what is the total square footage of your home? What is the square footage of your office space? How much did you pay for property taxes, mortgage insurance, all that stuff. And then it just becomes a percentage. And then if you own your home, you can take a depreciation percentage also. But I just encourage anybody who's self-employed to get a professional to do their taxes because, we want to make sure you're taking advantage of every little deduction that you can get for your home office, for your space. So yeah, it's definitely worth discussing with somebody.
I guess just for me, it makes sense that it was a percentage, but since I've never been truly self-employed, I just never even thought about it being a percentage.
I mean, I think it's a percentage of your heating and cooling bill and a percentage of your, cleaning service if you have one.
And even you can discuss this with whoever does your taxes, but if you have an office at your home that clients come to, you have to have some upkeep of the outside of your home also. That would be a decision that you could make with your tax preparer if somebody comes to your home. That doesn't happen that often, but, there might be therapists or something that, have clients come to their home.
Yeah.
So, if you can justify that as an office expense, it's worth taking that
into consideration.
Yeah.
Sounds like you have a lot of creative thinking that goes into this too.
Well, I mean, sometimes there is because you want to discuss every situation with every person, and every self-employed person is different also, so.
You'll hear some say, well, I don't want to risk audit, right?
Yeah.
I don't want a red flag.
Yeah.
I mean, is that a red flag?
I mean, usually we'll discuss with the client whether we think, it's some kind of audit risk or whatever.
Yeah.
But, sometimes I'm willing to dance in that gray area, I guess you could say,
sure.
right? I could justify that this is part of my work here.
Absolutely.
These are the boxes that I can check that say, Lexi comes to my house and we do a therapy session.
She therapizes me.
Yeah, maybe I don't know what we do, but every situation's different. So I think your tax professional would discuss with you whether, you probably overall they would discuss with you whether you had, red flags or whatever. Now, if your home office expenses were the same in 2023, 2024, and 2025, and all the numbers, that might be more of a red flag than the actual expense themselves, so.
Gotcha.
Yeah. And then if you have the receipts and invoices to back them up and
record keeping is, super important too with all that.
Yeah. So, I mean, going into selling a home and capital gains, so what would be considered a capital gain when selling a home, and how is that calculated?
So if you're selling your primary residence, which is probably what most people are doing, what we're talking about here, there's an exclusion of capital gains for your personal residence as long as you've lived in that home for two.
What's that number? What is it?
It's 250,000,
500,000
500,000. So most people aren't going to have. I mean, if you have over $500,000 gain in your home, good for you.
Yeah.
I think you might be okay with paying a little bit of capital gains tax.
Yeah.
And that's
but
like
most people are going to fit in that exclusion.
Yeah.
So
and that's it. You've lived in the home for at least 2 out of the past 5 years. Yeah.
And there, I'm not going to give specific tax advice or get into tax law, but there are some, things that can happen in your life that you can get around that exclusion. I mean, that you can, might change it. But yeah, in general, most people selling their primary residence are not going to hit that.
And then there is always a capital gains on investment properties, or can people get around
Likely. I mean,
1031 exchanges, reverse exchanges can get around that.
So anytime you have investment properties, it is always it would be my advice to have a tax professional help you out. And I would advise people to visit with that tax professional before they put that home on the market, or, you want to know what you're getting into. 1031 exchanges. I'm not an expert in 1031 exchanges, but you definitely want to have your ducks in a row on a 1031 exchange. So, you want to make sure you know what you're getting into. And
as a owner investor, so important to keep records of costs associated with stepping up the basis.
So that
right?
was where we were going to go with that question is, how do I know if I have capital gains? Well, what is your basis in whatever you're trying to sell? And that's with anything, a home or, whatever your basis is, what you've put into that home. So that's why we want that document, the settlement document when you purchase the home. And then you want to keep records of what you do to your home. Did you add on? Did you...
New AC.
Did you put in a roof? All that stuff goes into the basis of your home. So you want to have good records when you
when you go to sell.
Yeah.
And so, I mean, how does living in the home for a certain period affect the taxability of, well, I guess we already talked about capital gains.
Yeah, the 2 years.
Sale. 2 years. So how else could that maybe affect things from tax-wise?
The only thing I can think of is just the exclusion, living in it and keeping the records the whole time you're there. That would be the biggest thing. But it's the same thing if you have an investment property.
Yeah.
If whatever you purchase it for, and, most people when they purchase an investment property make improvements to it.
Right.
You probably put new carpet in there. You probably, and that's when you want a tax professional to help you figure out when you do those things, does that go into the basis of the property? Do you get to expense that?
Right. It could be maintenance. It could be.
Yeah, exactly. And most of those rules are fairly set, but, tax law changes and things change. And, you should always have somebody that is up on that kind of stuff.
Absolutely.
So,
yeah. I mean, I've had people too that have went to buy a primary residence, and then after 6 to 12 months, they want to turn that into an investment property, buy a different primary residence. But then they're not thinking about the capital gains and everything like that, and how they have to live in it for 2 out of the 5 years, or else they'll have to pay that. But if they own that house for 5 years, does capital gains just go away then?
If it was their primary residence and they fit within the exclusion. So as long as they, property prices are going up. You guys know that. But but $500,000 in gains is a lot to hit. So, it's definitely
something to think about. I was just thinking, because I know I've had people run that by me too. And I'm just like, yo, talk to your tax professional. Like, I'm not a tax person.
You know what? I think that's the best advice, Lexi. I mean, anybody who's doing investment properties or home purchases or whatever, you have a plethora of people who are experts in this area. You have your agent, you have your mortgage person, you have title companies, you have a tax person. It's great to get all those people, before you jump in on anything.
Yeah.
A realtor organization, we are, right?
Exactly.
A realtor organization would never suggest that someone sell their home on their own.
Right. Yeah. Yeah.
Why in the world would you prepare your own taxes?
Yeah. I mean, for some people, you get a W-2 in the mail and you can stick it in TurboTax and it'll come out just fine, right? But, there's most often it's much more than that. Even one spouse is self-employed, somebody sold a house, somebody's got investments, whatever. So it is, we're not all experts in everything. I'm not 100% expert in everything tax either, but I know where to go to get the information. We'll make sure that we...
But you still might miss something. So W-2, simple.
Yeah.
But what if I had a lot of medical expenses in a given year? And I might be a simple income earner, but maybe that state of Kansas itemization, as you said, is something that if I didn't know better, I might be foregoing some great opportunity to take some deductions.
Yeah, I mean, there's all kinds of crazy life situations,
Talk to a pro.
Yeah.
Talk to a pro.
Yeah.
Let's put it on a mug.
If you win the lottery, why don't you come talk to me about that also? All kinds of life situations. You never know.
Absolutely.
So, yeah, it's a good advice.
Wouldn't winning the lottery be nice?
Yeah, well, man. Would we?
I mean, then you might buy a home. You'd have to worry about that $500,000 exclusion if you were. Yeah.
Everybody has to ask that second question. Wouldn't it be nice? And then, would you work? Right? I mean, would you? I guess it would depend probably, but you might work at something else. But yeah. Anyhow.
I mean, if you don't want people to know you won the lottery,
that's true.
Wouldn't you still work?
Yeah.
Well, isn't it made public?
Not in Kansas.
Interesting.
You can remain anonymous in Kansas. Did you win the lottery and not tell us?
Can you not tell? I mean, I look like I won the lottery.
Yeah.
So, I mean, are there any common mistakes homeowners make when it comes to taxes that people should avoid?
Not keeping records, not having those records, probably one of the biggest things, or just not consulting with a tax professional to do taxes, missed deductions, but really, record keeping is probably the biggest mistake.
So what are some tips and tricks that you have for people for record keeping and staying organized with all of that over the years?
Well, we live in a digital world. So, all those records can be kept digitally. You don't have to print those out and keep them in a filing cabinet like we used to. I might be showing my age there, but you don't need
in your
that.
fireproof safe.
Yeah, in your fireproof safe. You don't need to do that. There's digital storage these days. So take that email that you probably got from your realtor that has that settlement statement. Take that invoice that you paid for your new roof or whatever, and stick it in your Google Drive or wherever you keep your documents. So we live in a world that's so easy to keep that documentation. You can even make a folder for every year and put that in there, and then you'll know where to find it instead of, grandma digging through her filing cabinet.
Or establish a relationship with an accountant and drop them off and you'll keep them, right?
Exactly. We are pretty much a paper-free office.
Yeah.
We don't have filing cabinets. So we have all that stuff digitally stored and backed up. And, if you dropped it off at our office, even if you changed accounting firms, you might not keep the same accountant for 10 years or whatever, but you could probably call them up. They might have it. I don't know, maybe. But yeah, record keeping is for anything really. And, home ownership, self-employed, any of that kind of stuff, keep those records.
So is there a certain period of time that people should keep those documents, or can they just have them on taxes 1 year and then they go the wayside, or just how long should people be keeping those documents?
That's a good question. So, depending on what we're talking about, if we're talking about purchase documents for a home, you should have that until you sell that property, right? If we're talking about, your actual tax return or whatever, depending on your situation, what your statute of limitation is, 3 to 7 years. But, like I said, in a digital world, you can keep that for. It's not going to fade. It's not going to.
I agree. I mean, I think if it took up room in the basement, people might purge that. But now with digital space being affordable and, documents don't take up much space.
No.
So you could keep it probably longer than you need to.
Yeah. Oh, yeah. Yeah. You can keep those. Yeah. even receipts, you can take a picture of a, receipt now and put it in a Google Drive or whatever and have it for however long you need it. Heck, if you need to take a picture of that settlement statement or whatever, just do that. It'll probably upload to your phone cloud and it'll probably be there forever.
Any apps you recommend for that quick storage, that quick picture taking?
There's an app called Dext, and it used to be called Receipt Bank, which I thought was a much better name than Dext, but
I just want DEXT.
DEXT. And it, you can just take a picture and it'll file your receipt for you. It's great especially for realtors who are trying to keep track of meals they might have with clients or whatever. Yeah. It'll file that away. And then if you were ever audited, Dext will just download a PDF of all your receipts and what category they're in and all that. So it's great. Yeah, cool. There's lots of technology that can help you out. There's mileage apps that can help you out with that kind of stuff.
Is Dext free?
There might be a free version.
A freemium.
I don't know. They're not paying me for this endorsement,
right.
So I don't really know.
Yeah.
No, I mean, I think the good version is a paid version, but there might be a free. But there might be other things out there also. But like a Google Drive is. Most people have a Google account now.
Right. Google Drive, OneDrive. I mean,
OneDrive, yeah.
You name it.
Yeah. So if you just snap a picture of it with your phone, it might automatically go. Now, you'd probably need to file it somewhere so you have it more organized. An app like Dext would organize it for you. But
although I needed to get my insurance or my license plate, and I know I'd taken a picture of it, some months prior. So in Google, I mean, it's so smart, right? I mean, I could
it's so smart.
Search license plate, and here come the images with the license plate.
Exactly, yeah.
So you can keyword search, even a document probably.
Yeah,
our artificial intelligence is
a little scary.
And helpful.
Yeah,
at times.
Yeah.
At times, yes.
Yeah.
So for this final question that we have, how does refinancing a home impact the tax filing, and what should homeowners keep in mind?
So with refinancing, the biggest thing is some people forget that they refinanced.
Yeah.
And then they forget to provide that second 1098 for the interest or whatever for the year. But usually there's a refinance document. You can give that to your accountant, see if there's anything on it that would impact. But the most important thing would be in January when you start to get those mortgage interest statements. If you refinance during the year, you're probably going to have more than one.
Yeah.
Yeah. Mm-hmm. You're going to have two. So just make sure you provide all, because your accountant is not necessarily going to know from looking at one. I mean, they might see, okay, wait, this was less than the last year. Did you refinance? But tax season gets crazy. So just make sure that if you refinance during the year that you are watching out for two interest statements. Or three if you refinance 3 times. I don't know. Do people do that?
It depends how much the rates move, I think.
Right. I mean, I suppose it could happen, right?
It's worth doing it.
Yeah. So just keep an eye on, when those tax documents start coming, open them up, scan them over, take them to your accountant, keep them.
What do you want to leave us with?
Can I ask one last question?
Yeah, sure.
Sorry.
No.
I'm full of... Okay, so, and we probably need a whole new show for this, but taking ownership of real property, trust versus private,
That's a good question.
I mean, are there some benefits to doing that? Or did we just open up a can of worms?
You just opened up a can of worms that Lexi's trying to wrap this podcast.
Yeah, we need more time.
And some of that might be more legal than accounting. So that would be a whole nother... There you go. There's a podcast idea for you.
So everybody, in the future, we are going to talk about trusts.
I think so. I think we should.
I think you could get somebody. There's probably we could find you somebody that would definitely know more about that. Yeah. We don't see that often. So
sounds like a good. We could have you back and bring an attorney in at the same time and bounce that back and forth.
Well, it'd have to be not during tax season, which we're about to enter.
That's true.
It's too soon.
Is there a down month?
No, actually no.
What do you want to leave us with?
What would I leave you with? Just record keeping really is really important. And, it's getting easier, but people still get really busy. And then where did I put that? And what did I do with that? And, I would just encourage people to keep good records and ask questions, ask the professionals, ask, before you make these decisions, you've got mortgage people, you've got your realtor, you've got a tax professional, just get good advice when you're doing all these things.
Use a pro.
Use
your partner. That's what we are. We're partners.
That's absolutely. Yeah.
Yeah.
And probably practice that discipline daily. Don't say I'll do a week at a time or even let alone a month at a time, but just it has to be a daily routine, right?
Yeah.
Make it a habit.
Yeah.
A part of your daily routine.
I mean, just like anything, right?
Yeah.
Like taking care of yourself and whatever. It's your financial health, your physical health.
I mean, it all does kind of intertwine.
Yeah.
Yeah. Sweet.
Awesome.
Well, thanks for joining us, Amy.
Thanks for having me.
Giving a little bit of a tax rundown.
I don't know if we made it as exciting as you wanted it to be.
I think it was, actually. I think it was pretty good. So you're amazing. And Lexi's fantastic. So it's a great conversation.
And Rob is fantastic.
No, not fishing. But
felt like it
you
needed to
guys
be said, right?
Yeah, you guys are fantastic. And you made it very interesting. That was great.
Yeah. Well, good.
And thank you to the Lawrence Public Library for letting us use this space. And it's just, I know I say it every single episode, but it's just because I'm very thankful.
This is such a community asset. And we're so fortunate to be able to use this space.
Yeah,
this is really
nice.
Terrific.
Yeah. Well, that's wrapping it up.
Yay.
Okay, signing off.
Thanks for joining us on Lawrence Real and Local, Keeping It Real podcast. We appreciate our guests taking the time to join us. Don't forget to subscribe and leave a review if you've enjoyed today's episode.
For more information, please visit us on the web, www.lawrencerealtor.com. And remember, whether you're buying, selling, or simply dreaming of your future home, we're here to help. Until next time, keep it real
And happy house hunting!